As we've been reporting, a volatile overnight session with stocks tumbling on Wall Street, with the Nasdaq saw its worst one-day percentage drop since August 2011. Well, joining me for his analysis is Peter McGuire from XM, live from our CBD studio. Peter, how much more of this volatility can we expect in the markets over the next few days?
Well, that's a great question, Adam. There's no doubt, it's been quite dramatic over the last, 4 or 5 sessions. You had that big sell-off the other night as far as crude, then you had last night equities. I think it'd probably whipsaw. You'll probably see further pressure. The US dollar's up, gold's up, and, the flight to safety. Let's just see how the US earnings are. You're right in the middle of that season as well. So I think it's going to be a fairly heavy November, and I think there's probably further pressure downside. Where it ends, let's go and see.
If we just focus on that volatility question a little bit more first. My understanding is the VIX Index, which of course measures volatility in the US.
Of the S&P, that's right.
Yes. That increased, I think it's around 20 or something like now, or 18, roughly around that level. But historically, that's still very low, isn't it?
Well, exactly right. I mean, when you put your mind back to where it has traded in, very volatile scenarios, the 30s, 40s, 50s, 60s, 70s. I noticed the other night when we saw that sell-off last week, it was up 70% in the night. So, it really whipsaws around. It's on the option price of the S&P 500. That's how it gauges. And you've got other VIXs for different markets as well, for, energy sectors and so on.
So is the contrast between those earlier decades that you mentioned and now that basically humans are playing less and less of a role in the actual trading, and it's more kind of algorithms, it's computers trading more and more?
Well, I think there's no doubting that. I mean, when you're looking at the hedgies and you're seeing the big market movers, there's no doubt, as far from a retail days of, the old chalky down there at the stock exchange, writing down the price in Bond Street, it's certainly changed a fair bit in those, 30 to 40 years. There is no doubt, I think, that you'll probably see those greater volatility moves going into even next year as well, because you've got the midterms coming up next month, and that's going to add more volatility and nervousness to the markets.
So what are the various kind of consequences of the midterms? I mean, just say the Republicans do well. Is that good for the markets?
Well, I think it's probably it boosts things up, but certainly it's a good sign. The other side, of course, is you've got what's happening with the Fed, so how that all plays into it as far as rate rises into 19 as well. Is there a flight to, if your equities do continue to be whipsawing, are people going to say, well, I'll sit on the sidelines, hoard some cash? It's very much a wait and see. The market's up nearly 30% since the inauguration, so it's been a great time for President Trump. I'm not sure whether we're going to see another 30% in the next 2 years.
Yep. Let's just talk now about the poor old Australian dollar, which has been falling, as we know, over most of the year, but it seems to have kind of levelled off or stabilised in this low US 70 cent range.
Yeah.
What's kind of keeping it there?
Well, there's many factors, but remembering that it's well down, the US dollar was trading for, as far as the index, was around about 89, 88 in February. It's now at 96, 96 and a half. So that's up against the basket of currencies. So as the US dollar strengthens, as we all know, the Aussie dollar comes off. It's oscillating around that 70 cent mark. It's very heavily traded on all the markets. It's one of the top 6 or 7 currencies pairs, US Aussie dollar. So I think that you're probably going to see it handbrake around here. If the US dollar really goes into a big drive in 19, then you're going to see the Aussie come under more pressure to the downside, possibly a 67 handle.
Now, currency traders sometimes talk about these Fibonacci resistance levels. I'm just wondering if you can explain to viewers what these are.
Well, they're technical analysis terms. Fibonacci is retracements, and mathematically, Fibonacci was an Italian, my understanding, Italian mathematician, and they're using those retracement methods and mathematics as far as pullback. So you've got 33, you've got 61, you've got these big headline numbers that traders look for, and then they map that over the actual graph and see what the retracement from a high to a low or from a low to a high is. Then they'll run something like a moving average across it, and that's what technical traders do. You've got the other side, of course, where fundamental traders, and then seasonality. So it's a term and it's a mathematical formula, but fairly simple to understand. So it's not that confusing. It's give someone 5 or 10 minutes. I think they'd get a fairly good picture of how it works.
Okay, well look, just turning to Europe now, and of course there's been some bouts of negative news there, I suppose, recently on the Brexit front and then also on the Italian front. So what implications have those those events had for currencies, the euro and the pound?
Well, the uncertainty with the euro is, of course, the Italian situation and, the strengthening as far as that US dollar. So that causes more concern across that, European belt. As far as Brexit's concerned and the UK pound, it's still a work in progress, as we're all very sure of and very mindful of. And as the US raises rates, that again causes more pressure on the UK pound and the euro to the downside. So those economies aren't in a ratcheting up process at the moment. They're very much staying pretty much level keel. And what's going to be interesting is if the US, and this is where President Trump's saying he doesn't want to see the Fed raise rates aggressively in 19. He feels as though it's fully priced. Let's see what happens as far as the stock market and what pressure that causes to the US dollar.
Do you think those comments of President Trump will have any effect on currency markets in terms of the outlook for the US dollar?
Yeah, I think that's going to be a hard one, Adam. I read something and I had a little bit of a laugh the other day. We talk about Alan Greenspan, and he mentioned that a jawboning of presidents is quite normal. He advised for Jerome Powell, the Fed Reserve chairman, to buy a set of earmuffs. So let's just wait and see whether he does buy those earmuffs and whether he does take on board. The Fed can have another view and say, well, look, if the president's going to be that way, we're going to be more aggressive on the other side.
Well, I've noticed that the frequency of comments has been increasing, and so I suppose the more he talks, the less impact any given set of comments will have. Of course, just back to the European Central Bank now, while we're still on the topic of central banks. Of course, the famous "whatever it takes" line. Has the ECB been very vocal ever since then, or it's been extremely cautious in its remarks?
Well, cautious to a point, but very much they are understanding the dynamics of the euro market. They're living and breathing with it. They understand from the debt side of it, what's happening as far as Italy, bonds, where's Greece playing, and all of those components melting in. There's no doubt that Germany's had a wonderful recovery. It's done very well since 12 or 13. France, very similar. Economic powerhouses within that euro region. But the question to everyone's mind is, are we going to see that continue to the upside over this 19, 20, 21 period? Or do we see a recession? And there's many analysts saying that the chances of that sometime in 19 or 20 are quite large. And that's the issue that probably where the ECB is. They're conscious of that and just seeing what happens with the States, China and so on.
Okay, Peter, thank you so much for that. That's all we have time for. We'll speak again soon.
Thank you, Adam.